Welcome back into Compounding Capital. My name is Colton, and in today's video, we're going to talk through news that just dropped on Pfizer, what my outlook is on the company, along with some deep value companies that I'm starting to look at. Now, if you were on the live stream last night, you would have caught wind that Pfizer was probably going to make a decent move pretty soon here. And of course, a catalyst drops that Pfizer is now moving forward with a once-a-day pill that's going to compete in the GLP-1 space. Now, it's just encouraging data in its early stages, so we're probably 12 to 18 months before really getting out onto the market and competing. But this is definitely promising for a company that's basically been left for dead. Nobody really has been looking at this. And if you're new to the channel, I'm definitely more of a contrarian investor. I look for these deep value distressed assets that's not being really covered, but still have some fundamentals underneath. And Pfizer did hit on these cylinders. Big concern with Pfizer is the dividend payout and the debt load now. This is a high risk type of investment, and I want to make it clear that I'm not recommending to buy or sell stocks. This is just my journey. For 99% of people, they should be looking at broadly diversified index, set it, forget it. But for entertainment purposes and my journey and the risk that I'm personally willing to take on, Pfizer is my largest position right now. You guys can see here that I have roughly 415 shares of Pfizer. Now, this is a portfolio I started to build this year. So if you're new to the channel, you haven't missed anything. This is a portfolio that I'm just starting to build out live with you guys. And you can watch my failures and or successes. Now, after Pfizer's been cut in half, it reached a low of roughly $25 a share. Well, COVID vaccines are not going to be a majority of where they're going to be making their money. And so that definitely ruined the pipeline of Pfizer and caused a lot of concern and obviously ruined the fundamentals within the company. But we had to look a little bit deeper of the acquisitions that they were making and can they be a player going forward? And that's basically the question I personally was asking. And so what I want to just do right now is keep this super simple. This is basically where I think the consolidation was happening for Pfizer. And what ended up happening was, I believe we formed a reverse head and shoulders pattern where we have a left shoulder here, the head is right here, and then we have a right shoulder formulating currently. And so this to me seemed like some sort of bottoming process. This is multiple weeks, multiple months of consolidation, basically between $25 and $28 a share, trading in about a 10% range pretty consistently with no real action or catalyst to kind of move the stock out of this range. Until today, I think we received a decent catalyst, but I also think that it's a long-term investment. This is not probably not going to really have price appreciation anytime soon, but this is definitely positive and should impact 2026 earnings in a positive manner, which the market has been discounting. So when we think about this, we could be getting a very solid investment at this point in time. With this news, and if Pfizer can really come to market with a GLP-1, analysts expect this industry to be worth roughly $100 billion by the decade. Now, this is also not including the acquisition of Seagen and what could come from cancer treatments, because that's really where a lot of the big bets are being placed, including myself. When we started looking at some of these larger pharma companies that are just trading at ridiculous valuations that basically have went up to skyrocketing levels, and you saw a company like Pfizer trading 4 times below their valuations, but still has pretty optimistic pipeline. To me, this was the contrarian move, and there was a lot of upside left in Pfizer. And if they can somehow keep this 6% dividend intact, then this could be a compounder. And so that's where my risk came in. I'm willing to take the risk on this. It's a high risk stock. This is not a slam dunk investment by any means. It has a lot of headwinds with the company. And when we started looking at where I was running my valuations, right around $24, $25, I thought the risk made a lot of sense for Pfizer. Running pretty conservative analysis here. Now, I definitely have a different outlook than most. I'm more concerned about total returns and not necessarily a dividend that's pretty scary when we look at the payout ratio. I personally believe that Pfizer should scratch the dividend for a year or two and actually acquire some of these biotech companies to build out the pipeline even stronger. I'd rather see them make really strong acquisitions while the market is tanking and while there's a lack of liquidity for these biotech companies. This would build out their pipeline, and this could actually grow their market cap exponentially, and total returns would become much higher rather than taking cash off the balance sheet and giving it to shareholders just to keep people happy. When we think about total returns, I think that would be the most efficient way for Pfizer to start working. And I also think that would be a way for them to stay ahead of their competitors and have capital appreciation for 10 plus years out. Now, of course, this is not a popular decision, but I look at total returns and I look at dividends as a return to capital, not an investment in the company. And where Pfizer's lying right now, I think investing in the future is absolutely more important than paying dividends. If there's no future in the company, then there's no dividends to be paid out. So my outlook on Pfizer is neutral to positive now. Before it was negative, but I thought the risk versus reward made sense. It's definitely more neutral to positive now. I do believe that if this GLP goes well, this is obviously going to help with their balance sheet. This is going to help with their free cash flow, which is my biggest concern with Pfizer. It's also going to allow the dividend to possibly stabilize and not be such a high payout ratio, which was one of my major concerns as well. With that being said, I'm neutral to positive, and I do think this $27 to $28 range is possibly a good entry point still. So I am going to bump up my analysis on Pfizer by roughly 5 to 10% of where I currently sit. Next, I really want to touch on Zoom Video, and I'm actually going to do the analysis live with you guys right now. I have yet to really dive into this one, but there's a lot of things I really like, and I think the market is absolutely discounting what the capabilities of this company is. Phenomenal balance sheet, really strong free cash flow, and valuation is absolutely at a historical low. Look at this company as being a COVID darling and a Cathie Wood juggernaut in the ARK ETF. This thing reached nearly $600 a share and is now trading at $56 a share. Now, even with this fallout, the interesting thing is that this company is actually still growing revenue, even though it is now losing market share to Microsoft Teams. Still growing at low single digits here, probably going to grow around 1 to 2%, even if they did nothing. And this is a company that can do over $1.4, $1.5 billion of free cash flow. Most impressive thing I like about the company is even though the market cap sitting at a measly $17 billion, the enterprise value is sitting closer to $10 billion, which means they have a positive cash position of $7 billion. Now, with a forward PE trading at 11 times earnings, this is pretty cheap right now. Clean balance sheet, good strong free cash flow, and a company that's still growing at some rate here. Where the opportunity is going to lie for this company is deploying that $7 billion, whether that's mergers and acquisitions, research and development, buybacks, putting a dividend in place. There's multiple things that this company can do to add value for shareholders and reaccelerate interest in the stock, which then would drive prices back up. But more importantly, I'd be interested in them making research and development and making an acquisition that can spider out to the current customers that they currently have. So really quick, I just want to compare them to their peers trading at 10, 11 times earnings, while peers are trading 20 times earnings. When we look at a price to free cash flow, something I actually really enjoy here, it's trading at less than 10 times price to free cash flow, which I really like. They don't grow. This really allows them to get very aggressive on focusing on their niche, and they're already talking about implementing AI. Where that comes in, I really don't know. That's not really my specialty, but I do think AI capabilities and us using video as communication is still in early adoption stages. I could definitely picture that being more and more prevalent in every aspect of our life. And so Zoom is positioned pretty uniquely here. They have a niche, and I think the valuation is pretty interesting as well, but we're going to dive into where I think the price target should be. So we get two price targets here. And now here's where I want to really break some things down. From a free cash flow standpoint, this stock could be around a $50, $55 a share, which means that, it could be a buy right now sitting at $56 a share. The growth rates I used in my analysis were 1%, 2%, and 3%, basically just keeping up with inflation. I obviously think they can do more than this. I think this is a company that could probably do pretty consistently 3% growth rates. So what I want to do is just show you that we're sitting right now at $41 and $49, which to me is giving a price target right around $45 to $46. This is where I would buy. This is where I would start looking at averaging in and getting a double-digit rate of return on a company like Zoom. But what I want to do is bump up the growth rates because I do think that they can consistently do about 3% growth rates. Is that going to be a straight line? Probably not. One year they might be down 5 or 6%. The next year they might be up 10%. But I do think they can consistently grow right around 3%. So when we add that into our equation, we get a $43 price target and a $54 price target, which now bumps it up to right around $49, $50 price target for me personally. So for Zoom right now, when we look at where they're currently trading, that would basically be a 10% decline from where we are, and that would be a forward PE sitting around 10 times earnings, which is extremely cheap when we factor in that they could possibly be a true AI player here. How so? Not really sure, but they're positioned for it in my personal opinion. They have an audience that is actively using their platform. And so now AI capabilities can definitely come in multiple facets, which could make them a pretty interesting AI play here and very, very reasonably priced, even if you bought today. So hopefully you guys enjoyed my dive into these two stocks. Now going forward, I am creating a watch list on live streams after market closes here. We're going to try to get some dates lined up. I might even do one today around 3:45 to 4:45. We're going to watch market actions. We're going to see if there's any opportunities that are kind of being overlooked by the market. Now, a couple criteria I want to talk about is I do want these companies to have some sort of fundamentals, some sort of top line revenue growth, some sort of positive EBITDA, some sort of possible free cash flow. So there has to be some fundamentals on the stocks that we're going to tracking, the stocks we're going to be putting on this watch list. That's the only thing I ask. I'm not looking for companies that are burning a tremendous amount of capital and that are very speculative. I'm looking for a speculative stock, but they have to have some sort of fundamental behind them, okay? So as always, guys, really appreciate your time, and we will see you in the next one.